This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's look at the last little bits of this chapter, which cover subsequent measurements, which leads us into revaluations. So subsequent measurements, so you've capitalised the asset at cost, you're going to depreciate it. What do you then subsequently do with it? Well, you have two choices, if you can recall. You have it at the cost model, which is nice and straightforward. You just capitalise it, depreciate it, and then impair it. So reduce it in value if there are any indicators that your asset has been damaged. And we'll see that in a later chapter. Okay, don't worry about the impairments for now. The more important aspect, and the bit that I want you to not worry about, but to concern yourselves with and to get good at, is looking at the revaluation model, which again is a bit of revision from the certificate level with a couple of whistles and bells added around it. Okay, so key bit there is that you go through and carry it at each year, the revalued amount. I say each year. What we'll see there is that you need to just keep it up to date. There's no specific rules about how many years that you need to perform the revaluations by, but going back to the framework, if there is a material difference between the carrying value and the revalued amount, which is the fair value, then you need to process the revaluation. If there is an immaterial difference, do not concern yourselves with it. It won't get the users of the accounts excited. Okay. So the focus is going to be on that revaluation model and how to deal with it. Just bits and pieces just to note. The first one we've dealt with, haven't we? They need to be periodically kept up to date. So make sure there is no material difference. A good one there is that we need a consistent policy for each class of assets. So you apply the revaluation model to all of your land and buildings. You don't decide to say, well, look, I'll apply the revaluation model to land and buildings located in one part of the country because I think they're going to go up, but I won't apply it to land and buildings in another part of the country where we operate because I don't think they're going to go up. Nonsense. Yeah, you apply it to every asset in every single category. Okay, tends to be land and buildings is under the revaluation model, and then other categories, motor vehicles, fixtures and fittings, plant and machinery, all tend to be held under the historic cost model. Okay. We revalue at fair value, so that, just be careful, needs to be done by a professional valuer. So you can't get somebody, so your friend who is in work with you, and say, look, can you value that building for me? They need to be qualified, they need to be professional and have passed all their exams, like yourselves, in terms of your management accountancy. Okay, and then the key bit there is once you have revalued it to fair value, you depreciate it, but you depreciate the revalued amount, so the revalued asset, over the remaining useful life. Okay. There we go. So not over its original life. Look at how many years have expired and then see what is left. Okay. Again, there isn't really anything new from what we've seen before at the certificate level. If we go through then and look at the accounting for a revaluation, bit of a blast from the past. Remember, what you have there is that the gain goes to other comprehensive income. Don't worry about a loss. We'll deal with losses when we get to impairment in a later chapter. And what you go through and do there is that you debit the cost to get it from its cost originally to its revalued amount. And don't forget there as well that you need to remove the accumulated depreciation. Accumulated depreciation is a credit balance. So to remove a credit balance, you need to go through there and debit it. Okay. Don't worry too much about the debits and credits. I'll draw up a standardized working for you to help you with the revaluation. But just be careful. It does say there the figure posted to the revaluation surplus, which is that figure there through OCI, can be quickly calculated as follows. So essentially what you do there is that you just take your fair value, don't you, and you deduct the carrying value, because that's where we are going from and to, isn't it? You take the carrying value up to the fair value. Okay. There's a tiny little note at the bottom. I think we'll discuss that as we go through the example. What tends to happen is because you've revalued the asset upwards and you depreciate it over its remaining life, that higher value of the asset tends to lead to a higher depreciation charge. If we compare that higher depreciation charge to the old depreciation charge, so before we revalued, we may see that we now have some excess depreciation. Okay, and with that excess depreciation, you can do what's referred to as an annual reserve transfer, and we'll talk about the debits and the credits in a moment. Okay, I already feel as if I've spoken about that too far already, but just so that you have an awareness of it. Okay, excellent. So let's go through, have a look at the example with regards to revaluation. It says, show how the revaluation will be accounted for in the financial statements for the year is it to December X7. Okay. So it says there, Charlie bought a building on the 1st of January X5. So is that 3 years ago? For $500,000. You're already thinking 3 years ago, is it? Yes, 5, 6, 7. Yeah. With an estimated useful life, is it there, of 25 years and no residual value. Straight line method was adopted, so you could automatically work out the depreciation, couldn't we? You've probably done it already. 500 over 25 is $20,000 per annum, isn't it? 1st of January 20x7. So is that at the start of the year? We decided to revalue all non-current assets in line with IAS 16. The building was revalued, is it to 600, and the life is unchanged. Okay, so I need to work out the carrying value of the asset, don't I, to then compare that to this fair value of 600,000, and then that 600,000 is going to be depreciated over the remaining life. What is the remaining life? Okay, well, it was 25 years originally. Be careful, it was revalued at the start of the year. So the start of the year, you're looking at X5 and X6. Okay, so only 2 years have gone. So there are 23 years remaining. Okay, by the end of this year, 3 years will have gone. But the revaluation, the key bit, took place at the start. Okay, there we go. So let's go through there and look at how we account for it. And what I do is I put up a 4-column approach whenever I have, is it there, a revaluation. So I go through there and look at my narrative. I look at my historic cost. So I'll just put HC. I look at my revaluation, and then I go through there and look at the surplus. Okay. The narrative, we go through there and look at the original cost. So the original cost, was it $500,000, wasn't it? Okay. We need to work out the carrying value, and the carrying value there at the 31st of December X6, isn't it? Okay. The original cost was the 1st of the 1st X5. Okay. All of X5, all of X6. Okay. And the reason why we need the carrying value at X6 is because we then need to revalue it, don't we? To its fair value, is it of 600, and then we need to work out how it's then accounted for up until the end of the current year, which is there as X7, isn't it? Okay, so key bit is that to work out my depreciation, it's there, isn't it, as 2 years. So it's the 500,000 divided by 25 multiplied by 2 years. So it was 20,000 for 1, 40,000 for 2. So does that give me 360,000? Oh, careful. 460,000, isn't it? Okay, careful. Once you've got that, the increase, the gain is it as 140,000. Okay, I told you not to concern yourself too much with the journal entries, the debits and the credits, but if you so wish, because I know what you're like, you love the world of financial accounting so much, you need to debit the cost, debit the accumulated depreciation, and credit your other comprehensive income. Okay, well, the accumulated depreciation that we need to remove is it there of 40,000, isn't it? So I need to get rid of that. Okay, the cost, well, the original cost I think was 500, wasn't it? It's now revalued to 600. So is that 100,000? And the credit to OCI, essentially in this instance, by the way I've done it, is a balancing figure. But what you can see that we have done is that we've just taken it from its carrying value of 460 up to its revalued amount of, is it 600? Okay, there we go. So that surplus of 140 sits there, doesn't it, this year within OCI, or the comprehensive income. Happy with that? Hopefully so, because I think you did similar stuff within the certificate level. So what you've got now, however, is to work out the depreciation for the current year. Is that the X7? So the revalued amount is now 600,000. Remember, we said 2 years have gone. So there's 23 years left. So that gives me a horrible number. Is that 26087? So that's the depreciation charge for the year, which goes there. Is it through the statement of profit or loss? Which when I go through there and net off, let's just check on my calculator. I'll do it mentally. That's going to be a disaster. 573,913. I think that's right, isn't it? Looks about right. 600,000 less 26087. 573,913. That's the first time in a long time I've ever done something such a large number in mental arithmetic and actually got it right. So well done me for a change. There we go. Key bit is that is the figure that appears on the SFP as your non-current asset. Now for the fun bit. Okay, the fact there that what we previously will have done is we will have charged 20,000 for our depreciation, wouldn't we? And now we've charged 26087, which is a bit unfair, isn't it? Because the gain that we took on the asset has gone to other comprehensive income. But if we're taking the gain to other comprehensive income and not to profit or loss, then it's a bit unfair to take an extra depreciation expense to profit or loss, isn't it? Because that extra expense is reducing my profitability. That profitability feeds into retained earnings, which is a distributable reserve. So essentially it's reducing my distributable profits. Now this revaluation surplus is not distributable. Okay, so what you've got there is the excess depreciation is 6087, which gives me my surplus at the end of the year as 133,917. So what we see there is that 6087 is a reserve transfer in the statement of changes in equity. So we shall draw that up in a moment to show you what you have. But the key bit is to understand that for this excess depreciation, the difference between the old and the new needs to go there as a reserve transfer. So if we go through there and have a look at how that would work, within our statement of changes in equity, okay, you would have there, is it your retained earnings? Is it there your revaluation surplus, so an other component of equity? You'd have your brought forward figures, which we don't know what they are. I will assume that my revaluation was nil. You then have your revaluation gain that's taken place in the year, which was $140,000. And then you have your reserve transfer. So what we do is each year we take 6,087 from your revaluation surplus and we transfer that to your retained earnings. Because then what happens is that from your retained earnings you have your dividends that will be paid, and therefore the shareholders are in no worse a position with regards to the distributable profits that are available to them. Okay, again, just to complete, 133,913. Okay, there we go. Okay, again, bits and pieces that you could be asked for within exam questions could be just to work out what is the revaluation gain through OCI, which is that figure there. It could ask you to go through and work out the new depreciation figure, which is that figure there. It could ask you to work out the carrying value. It could ask you to work out the excess depreciation. So, if I was an examiner, I'd have plenty of bits and pieces to go through there and try and test you to the Pepsi Max. Okay, there we go. Excellent. So just then got to go through and finish it all up. Dot the I's, cross the T's. The disposal of a previously revalued asset. There's nothing to it, ladies and gents. Okay, what you go through and do there is that you get a profit or loss on disposal as calculated previously. So you just take your proceeds and compare it to the carrying value at the date of disposal. And what you have there is that any gains held in reserves are transferred to retained earnings. Okay, so again, you have that reserve transfer. So again, you are debiting the revaluation surplus, crediting your retained earnings, okay, with whatever is left. Okay, so if we think about that last example, imagine on the first day of the next accounting year that we sold the asset, you would get a profit or loss on disposal, and that profit or loss on disposal would have been based upon the carrying value of 57913. Okay, and then what you would have is that you would have a big reserve transfer. You would remove whatever is still held within your revaluation surplus. So we have, is it 133,913 that was there. So we would then remove that and transfer it all into retained earnings. Okay, I think what I'm going to go through and do is I'm going to get you to have a go at the next example yourself and then just use the answer to make sure that you're happy with it. Because I'll chat through it briefly just to make sure that you know what's happening. But I don't really fancy working through the whole question, given that it's a good opportunity for yourselves to get used to the revaluation. Okay, so what you've got is it wants you to work out the profit or loss on disposal. The profit or loss on disposal was at the 1st of January X9. And it wants the journal entry for the previously held gains for the transfer within the reserves. Okay, so that little journal entry above, it wants you to work that out, and the profit or loss on disposal. To work out the profit or loss on disposal, we need to work out the carrying value. So you can have a go if you want, hang fire a moment, use the same pro forma, use the 4-column approach, narrative as your first column, second column historic cost, third column revaluation or revalued amount, and the fourth column the surplus. Okay, because what you've got there is on the 1st of January X5 we bought it for 400,000. Again, a life of 25 years, and we depreciate it straight line. Okay, so you can work out whatever the depreciation charge may be. Is it 400 divided by 25? I'm not going to work that out. I've already had my luck with mental arithmetic once already within this little session. 1st of January 20X7. So again, that there is the start of the year. So we will have gone through there, won't we? X5 and X6 would have depreciated it for 2 years before they then revalue it to, is it 500? So you need to work out the carrying value after 2 years, and then you can then revalue to 500. The subsequent depreciation is that the life is unchanged. So if it's 25 years, 2 years have gone. Yeah, you know already there's 23 years left. So we're going to depreciate it for all of, is it X7 and X8, because we then dispose of it on the 1st of January X9. Okay, so you will need to depreciate it for 2 years. You will need to do 2 years worth of the revaluation transfer, so the transfer through the statement of changes in equity for the excess depreciation. And then when you're working out the profit or loss on disposal, you base it upon the proceeds of 550 compared to the carrying value at the end, is it there, of December X8, which is the same as the 1st of January X9. Okay, so have a go through, work it through, the answers at the back. I think it's all right, it's all correct. Hopefully you shouldn't get too stuck on it. If you do, refer back to what we've just chatted through there to work out the numbers and the figures. If you do get desperately stuck, then feel free to ask on the Ask a Tutor forum. Other than that, we'll move on to the small little bits of accounting standards to do with property, plant and equipment, or related to property, plant and equipment in the following sessions. Other than that, I'll see you all later.